It's U.S. consumers' darkest warning yet. I'm Steve Van Metre. Expectations are crashing, prices are rising, and paychecks are shrinking. What comes next can only be described as hell. Plus, my subscribers locked in a 7% gain in just under 2 weeks. Our next big trade is already underway. Stay tuned to the end of the show to learn how you too can make big money in these markets. Now, let's pick today's story up with the headline is U.S. consumer confidence tumbled again in March. And I want you to think back after the election. What did we see? Business confidence surge, consumer confidence surge, and then in the months that follow, it started to all come unwound. Now we're seeing confidence plunging at the fastest rate since the COVID pandemic. The expectations index based on consumer short-term outlook for income, business, and labor market conditions dropped a whopping 9.6 points to 65.2. This is the lowest level in 12 years and well below the threshold of 80 that usually signals a recession ahead. And why all of a sudden are we seeing consumers start to see a recession coming? Is it just because of the tariffs and prices are increasing? No, it has everything to do with their incomes. Because in a consumption-based economy, when consumers start to worry about their jobs, their business, and their income, which they're already seeing signs that they're likely to hit the unemployment line, those who do keep their job are seeing their hours get cut and their paychecks shrink, what it means that they have less money to spend in the real economy. When that happens, it starts to backfeed and tells us we're headed right into a nasty recession. Consumer confidence declined for a fourth consecutive month in March, falling below the relatively narrow range that prevailed since 2022. Of the index's 5 components, only consumers' assessments of present labor market conditions improved, albeit slightly. And why is that? It's because consumers aren't losing their jobs. Now, they're seeing people that have lost their job, they're going on unemployment, and they're getting stuck there for long periods because the outlook for those who are on unemployment is very bleak. There's not a lot of jobs being created despite what we're seeing from the government headline non-farm payroll report. The challenge here is consumers are viewing that they're likely to lose their job, but they're thankful, at least in the short term, they have it. Now, I want to know from you, are you worried about losing your job? Weigh in the comments below. I want to know what's going on at your workplace. Let's talk about the unemployment rate and the relationship between consumer sentiment. Now, we don't have the Conference Board data available in the Fred database, but we do have the University of Michigan data that's shown in red. And you can see that as confidence goes down, it's a direct relationship to the labor market. As you see the unemployment rate in blue rising, we see that happen in the 91 recession. We see it happen once again going into the dot-com bubble as the decline in confidence had everything to do with the labor market unwinding. Happened again during the global financial crisis. And based on what we're seeing in the survey data, what consumers are telling us is layoffs are about to hit. That means the unemployment rate, despite what the Fed recently said, is likely to skyrocket well above their level of where it's supposed to go, meaning we're headed into a massive recession now, with consumers indicating it's coming this year. And likely in response to recent market volatility, consumers also turned negative about the stock market for the first time since the end of 2023. And for good reason, because there's a relationship between the equity market and the labor market. Let's take a look at this chart as we overlay the NASDAQ 100 against the unemployment rate. That's still shown in blue. And what we can see going in the dot-com bubble is as the unemployment rate started to head higher, stock prices came crashing down. It happened again going into the global financial crisis. The labor market started to unwind, the stock market rallied, and then next thing you know, both started to fall apart. Now we see the unemployment rate rising, but consumers came in and bought stocks in a big way, hoping that that was going to reverse. Now we're starting to get clear signs as confidence has crashed into the worst rate since the COVID pandemic that we're going to see rising unemployment, and that means for many investors, stock prices likely to come down. Of course, the danger sign here is there's a lot of leverage in this market that's going to come unwound with it. And consumers' views of their family's current financial situation improved slightly, but their expectations for future finances declined to the lowest level since July of 2022. Now, I want to know from you, are your expectations for your future income, for your business, for your job, is your outlook that they're declining? I want to know. Weigh in the comments. I want to hear what's going on from you, because the proportion of consumers anticipating a recession over the next 12 months remains steady at a 9-month high, meaning a lot of consumers now starting to price in a recession this year. Now, what happens when businesses and consumers start to expect a recession? They start to respond accordingly. They spend less, they save more. And of course, from a business perspective, it means you lay people off. This is a dangerous sign that hope for many American consumers now is lost. But if your finances are headed down, you can turn them up. Here you can see that trade on Brazilian equities that we put on earlier this month. We got stopped out at 7.08% gain. Now, many people always ask, Steve, how do you know when to sell? Well, use your risk control levels. Stay tuned to the end of the show. Hit the links in the description. Grab the coupon codes for your free 30-day free trial, because we're going to show you how to trade and make money in this market. Because for a lot of families and a lot of households, it means they're going to see their incomes go down, because when the unemployment rate rises, you see the average weekly hours also goes down. So when we look back at the Conference Board report, it says households are worried about their income. They're worried about their business and their finance, and for good reason. They're seeing their income in terms of their hourly rate go up, but their bottom line, their take-home pay, is going down, because as employers give out raises, they're also cutting hours, and that means they're cutting jobs, as we're starting to see now. And what happened going back into the 91 recession, you can see there was a long period that employers were trimming hours back. But once it got under around 34 and a half, what happened is employers started to lay people off. Now, if you're wondering why there's this inflection point where businesses start to lay people off, it's because they want to keep their most valuable employees, and to keep them, they have to give them more hours. The sacrifice is you lay people off that you don't want to keep. You can see going into the dot-com bubble, hours worked are getting cut. It hits the inflection point. Next thing you know, employers are laying people off. We see the same thing happen once again during the global financial crisis. And look again what's happening now. Hours worked have been getting trimmed. Paychecks have been shrinking, and now workers are realizing, even though in the short term they have a job, the risk is they're going to be losing their job, or someone they know is going to be losing their job, and that is why you're seeing confidence plunge. But yet on a 6-month moving average basis, purchasing plans for both homes and cars decline. So here you have large ticket items. People are saying, look, I'm not confident about buying a home or a car because I'm not sure I'm going to be able to pay for it. But look at this. This is very interesting. Given the anxiety about the future, intentions to buy big ticket items, including appliances and electronics, ticked up, which may reflect plans to buy before impending tariffs lead to price increases. Now, I want to know from you, is this how you're responding? Are you buying big ticket items like appliances and electronics before the tariffs? Are you looking at buying a home or a car? Weigh in the comments below. I want to hear from you what's going on in the real economy. Write-in responses also show that inflation is a major concern for consumers, and that worries about the impact of trade policies and tariffs in particular are on the rise. And we know it's not just about inflation, because if workers were seeing not just their wage increase, but the number of hours they were working go up, and ultimately their take-home pay rising, they wouldn't worry about inflation as much, because they know they could afford higher prices. In this case, we see shrinking paychecks against rising prices. We know this is a major problem, and now all of a sudden there's effective tariffs that could send prices even higher than they are now. And I want to know from you, are you worried about the impact of tariffs on your bottom line, or do you think it's not going to be a big deal? Weigh in the comments below, because now what we're seeing from the regional Fed surveys is everything we said were going to happen. The decline in confidence is backfeeding into businesses, now into manufacturers, and even worse into the services sector. As we take a look at the Philly Fed non-manufacturing or services sector outlook survey, and what they noted is it continued to decline. Now, many of you said yesterday, Steve, look, we're not a manufacturing economy, we're a services economy, so it doesn't matter what happens in the manufacturing sector. Well, my friends, it does matter. We do have manufacturing here, and quite a bit of it, but now what you're seeing, just what I told you would happen, where manufacturing goes, services follows. Full-time employment index fell 10 points to -7, showing signs the services sector is laying off. Part-time employment declined to 12.4 to 3.5. And here's a big one. The average work week index rose from -7.5 to 1.5. So wait a minute, what happened here is that people are losing their job. Just as I said, what happened to give people that employers want to keep more hours. So despite the fact that the average hourly work week went up in Philly, it was at the sacrifice of job losses. As we look at this chart of the unemployment rate against average weekly hours of production and non-supervisory employees, and again, you can see the very clear relationship as hours worked go down. And remember, it doesn't go down in a straight line. People hit the unemployment line. You see that happen here around 1994 and 96. A reduction of hours worked leads to a flatlining of the unemployment rate, but then every cycle after that, you hit an inflection point where hours worked goes down and the unemployment rate goes up. So what we're seeing in Philly is something we're seeing in every cycle here as employers. Again, trying to hang on to their most valuable employees by giving them the hours they need. The problem here is it creates a feedback loop. As you send people to the unemployment line, their spending power goes down because their incomes go down. And next thing you know, everybody else is suffering as well as the economy spirals down. And prices are set to head higher as price indicators suggest increases in prices for the services sector, for inputs, and the firm's own goods and services overall. So despite the fact that demand is weakening and that companies are laying off people just to keep their most valuable employees, they're seeing price pressure to the upside. But check this out. Most of the firms, about 60%, reported no change in prices received. So despite the fact that they're raising prices, they didn't receive higher prices from consumers. What is this telling you the services sector is doing? They're taking the hit at the margin. Now it starts to make sense. Why have they been cutting hours? Why are they cutting jobs? Because services sector employers are eating the loss here at the margin, and that's not going to continue a whole lot longer because the general future activity index suggests that the respondents expect continued declines in activity in the services sector over the next 6 months. So all of a sudden, again, after the election, what happened? Outlook surged higher. Now, due to declining confidence from consumers, we're seeing business outlook to the downside, and that's all it's going to do is lead to more layoffs. And let's turn to the Richmond Fed. First, we'll look at the manufacturing activity index. What do we see here? It slowed in March. The composite manufacturing index fell to -4 in March from 6 in February, led by a notable decrease from 12 to -7 in shipments. And the other two components, new orders decreased slightly and employment fell to -1 from 9. So again, here we see more signs that demand in terms of new business going down, and we see, of course, employment going down. So it starts to make perfect sense why the conference board is reporting a massive plunge in confidence. And again, what did we hear from workers? They're saying we're concerned about our income, we're concerned about our job, we're concerned about business, and it's all very clear what we're seeing in the regional Fed surveys and why all of a sudden you're seeing everyone start to see a recession right on the horizon. The average growth rate of prices paid increased notably as the average growth rate of prices received increased, but not by as much. So again, we see manufacturers taking a little bit of a hit at the margin as they try to raise prices, but can't pass them through all the way. And firms expected heightened growth in prices paid and some growth in prices received over the next 12 months, meaning their expectations for future inflation is headed higher. So now we can see very clearly that not only is there danger signs in the manufacturing sector, as we talked about yesterday and from Richmond today, but you see signs in the services sector because the Richmond Fed also noted in their services report today that signs of weakness are increasing. But not to worry, Fed's Kugler is watching pickup in prices, inflation expectations. It's a good thing they're watching because they're going to watch what happens when you get monetary policy wrong and you send an entire economy right into recession. I'm paying close attention to the acceleration of price increases and higher inflation expectations, especially given the recent bout of inflation over the past few years. And here's what's interesting. Inside their own surveys, from the regional Fed, that we're seeing price increases, not just in manufacturing, but in the services sector. This is coming not only today, but in the next 6 months and possibly even more once the tariffs hit. The share of consensus expecting higher interest rates, this from consumers in the year ahead, rose to the highest level in almost a year, this according to the Conference Board. So consumers now expecting interest rates to go up. Now, why is this a problem? Well, it's because in a slowing economy, as consumers lose their job, their income goes down. And that means, of course, against higher rent, higher food prices, and higher energy prices, well, their money doesn't go as far. The challenge then is that means you stop paying on certain bills, such as your credit cards, that really right now consumers need to see their bills go down. Higher interest rates say their minimum payment is going to go up. We know what that means for the delinquency rate. It's already pushing higher and set to go up even more. She noted the recent data on economic activity had shown some signs of softness. Well, clearly they're not seeing the big picture here, like a decline in retail sales in January, but added it may reflect factors such as weather disruptions and seasonal adjustment issues. So what you can see here from the Fed is bias. They want to keep interest rates higher. They're blaming it on weather and other factors. Of course, we know that's not the case. As she described the labor market as stable, what we can see based on the data, it's anything but stable because consumers in the Conference Board report notated concerns about their finances, concerned about their jobs and their businesses, and we saw the consumer confidence plunging at the fastest rate since the pandemic. The labor market is anything but stable. In fact, based on what we're seeing from consumers, it's about to unwind in a major way. But just because the economy's unwinding and you might lose your job doesn't mean you can't make money in the markets. Here you can see our trade on Brazilian equities got stopped out yesterday for a little over a 7% gain. Now, many people ask, how do you know when to sell? Well, I don't, but that's the purpose of risk control levels. We put trades on, we give our subscribers initial stop levels, and then along the way, when we see price go up, we tell them to raise those levels. We let the stop losses do the work so we don't have to sit in front of our computers all day. But how do we do this? Well, we trade against the machines. This is called our CTA Timer Pro report. And the way this works is we look at the broad equity, bond, currency, and commodity markets each and every day to see how machines are positioned. But we look at historicals and we run an overlay of how they should be positioned versus how they currently are positioned. And what we look for is positioning where the machines have to buy so we can get our subscribers in before that and out before the machines sell. Now, all that historical data is built right into our reports. It generates a hot list every day. In addition, we look at a core screening across every positioning, and what we're looking for is signals when the machines are particularly massive short or in a buying mode that our historical model suggests it's time for us to buy in. Now, you get the report each and every day. You get all of the signals, but even if you don't look at the report, we give you all the notes on what I think are the best trades. I give you risk control levels, and again, all of that historical data is built right into our models. We give you a full tracking of all our open trades and return a weekend update with, again, updated stop loss levels and positioning. I disclose how I personally trade the reports, and here's the best part, you get a 30-day free trial. That's right, use the links in the description below, grab those coupon codes because we're so confident you can make money trading our reports. We want your first 30 days to be on me. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.